Bond King Jeff Gundlach warns, the odds of a Fed rate cut are 80% in 2023, as unemployment surge will shock you. Billionaire investor Jeff Gundlach believes the odds of a Fed policy U-turn are 80%, given the U.S. economy is highly likely to have a meltdown in 2023. Based on the pricing action of the markets on Thursday, S&P 500 gapped down 2.5% after rejected by 200-day moving average 3 times on the daily just in December. So much for the Santa Claus rally. We have Netflix falling out of its weak rising channel. The news was the ad-supported tier is falling short against competitors. Even Apple stock falling big, down 5%. TLT is in the green today despite the Fed funds rate is rising. We have a neutral rating of 51 on the Fear and Greed Index. From AAII Sentiment Survey, we have 44% of people feeling bearish. Has the crash already started? Why is TLT keep moving up when the Fed just raised the short-term rate 50 points higher? Why do I think unemployment surge will shock people next year? I will explain it all right after this. And of course, smash the like button. If you want to be my good boy, apply to write your first book with me. Welcome back to the Audacious Money Witch channel, where we talk about macroeconomy, stocks, bonds, and commodity markets. If you like any of these topics, you are intelligent. That's why you're here, and you know what to do. And push my button if you like what you see in today's video, because I can't push it from this side. This video is brought to you by my Patreon. If you are a good boy, go to patreon.com/magicalgoddesscheryl to add more meaning into your life. If you play your cards right and completely submit like my good boys do, then I will take you under my wing. Author of best-selling books, Goddess Cheryl. My good boys always get rewarded handsomely. You are such a good boy. You like hearing that, don't you? You want to get into the bookstore. You want it to be real. You want it to be true. You need to be my client, don't you? Gundlach believes the aggressive monetary tightening by the Fed will trigger an economic meltdown by next year, forcing policymakers to cut rates. I think the odds are probably greater than 80% that there's a rate cut in 2023. I think the pivot will be just as quick when they face the adversity, which is the effect of the policies. The tremendous interest rate increases that we've just seen in the past 9 months or so, he added. Inflation has been slowing over the past few months, with November's numbers at 7.1%, down from October's numbers climbing at 7.7%, down from the previous month's 8.2%, and a June peak of 9.1%. If you have that kind of momentum on the downside, it's just not going to stop. You just don't stop in your tracks right there. You have momentum going. I think there has been some progress on inflation. Nobody's really talking about all of these runaway price increases anymore. I think the inflation rate is going to fall faster than most economists do. Gundlach's comments come after the Fed delivered an interest rate hike of 50 basis points Wednesday, as part of its continued efforts to cool inflation toward the 2% official target, down from 7.1% in November. The central bank has boosted its benchmark rate by 425 basis points this year to 4.25% to 4.5%, the highest level since 2007. The Fed is predicting higher inflation, higher unemployment, lower GDP, and more rate hikes than the September 2022 meeting. The Fed never predicts recession. The latest Fed median projections suggest officials will lift rates to 5.1% by the end of 2023, dashing any investor hope that the institution will pivot from its aggressive policy amid growing recession risks. Gundlach pointed to an inverted yield curve in the bond market as a flashing sign of an oncoming economic downturn. I think they should not do any more hikes after today, Gundlach said. In Gundlach's view, the Fed isn't being transparent about its inflation target, saying he doesn't think the central bank actually wants to drive it down to 2%. I secretly believe the Fed's inflation target is more like 3% now. If we get down to 2%, I don't see any way it's going to stop there. It would be so much momentum to the downside that I just don't know if they really want to go that far, he said. They just don't always articulate the moving of the target because that makes them look weak. It makes them look indecisive, he continued. Why do I think unemployment surge will shock people next year? The simple answer, as shocking as this may sound, there has been no change in the number of people actually employed in the past 8 months. But due to deterioration in the economy, more people are losing their higher paying full-time jobs and switching into much lower paying, benefits-free part-time jobs, which also forces many to work more than one job. A rotation which picked up in earnest sometime in March, and which has only been captured by the household survey. Meanwhile, the establishment survey plows on ahead with its report card motivated approximations, seasonal adjustments, and other labor market goals seeking meant to make the Biden administration look good and provide the Fed with ammo to keep rates high. In other words, while the labor market is already cracking, it will take the BLS several months of veering away from reality before the government bureaucrats accept and admit what is truly taking place. There are 3 head and shoulders charts represent the coming recession crash in stocks. We know stock market always pricing in recession the fastest ahead of real estate and more damaging news to the economy. This year, we already have countless tech companies laying off workers. Which part of the stock market was sold off first and the most? It's the NASDAQ, the growing tech companies. There are a couple of most loved companies holding on to price quite well. One is Apple. Check out its head and shoulders pattern on this chart. Another one is Tesla. It has a massive head and shoulders patterns. If this pattern played out, Tesla will fall at least 70% from the high of 2021. Also, Tesla has recently had a kiss of death triggered on the monthly. Tesla is the most popular retail stock. The third Head and Shoulders patterns is right on S&P 500 chart. It looks like it's playing out as we speak. TLT just played out its own Head and Shoulders pattern, resulting an almost 50% fall from the top of 2020. If Apple and Tesla keep on falling, it will create huge fear in the market, triggering a stock market crash, not only in NASDAQ, but in the Dow as well. Most of the industrial stocks in the Dow didn't even fall as much this year, as the Dow haven't even went down 10%. That is market illusion. Those are late cycle stocks. These stocks will fall fast in recession as we're heading towards a deep one next year. We will start to see those companies start to report layoff the same way as in March of 2020. We also have aging workforce. Aging is bad news for future economic growth, too. The available workforce will expand much more slowly in coming years than it has in the past. Economies won't be able to produce as much. And we don't think aging populations consume substantially less either, particularly when you factor in healthcare demand. That is why I think unemployment in 2023 will be as shocking to Main Street consumer sentiment as inflation in 2022. As for inflation long term, there is no guarantee that globalization will be back as before. Once the demand is back, we still don't know if we will have enough energy supply. This is my client Ted Eazzy's book, Wicked Pussy Perfume. It is an erotic novel, such an awesome book. Order your copy for Christmas. And my client David Vine and Jama. This is a collaboration book and it's called Ignite the Passion, Co-Create Your Dreams. Such an amazing book. And my book, Lightning and Thunder, Discover Who You Are. You are such a good boy for watching my video right till the end. Bye.